Silver is sitting on a hair trigger right now, and almost nobody in this market is talking about why. One number dropping this Friday at 8:30 a.m. Eastern Time could either launch this metal into a move that redefines the second half of 2026 or slam the brakes on everything we have watched build since January. Stay with me because I am going to show you the exact mechanism, not opinion. I'm going to walk you through the data from COMEX, the Silver Institute, JP Morgan, and Bank of America, and let those numbers speak before I give you a single interpretation of my own. There are three things you need to understand before Friday arrives. First, I'm going to show you exactly how the non-farm payrolls print mechanically moves silver, and why this particular report hits different than any NFP we have seen since 2022. Second, I'm going to show you what is already loaded into this market right now at the structural level, the supply deficit data, the COMEX inventory numbers, and the gold-silver ratio compression that has been building quietly for weeks. Third, I'm going to give you both paths forward with specific price levels and time frames so you know exactly what to watch for and what it means. Build this from the ground up because every layer here connects to the next. Silver right now, as of June 4, 2026, is trading at approximately $74.49 per ounce on COMEX after pulling back from a two-week high near $76.67 on June 2nd. That pullback is not random and it is not panic selling. It is the market holding its breath ahead of Friday's May non-farm payrolls report from the Bureau of Labor Statistics. Before we get to the scenarios, you need to understand why this particular NFP carries so much more weight for silver than it would in a normal rate cycle. The Federal Reserve is currently holding its benchmark rate in the 3.50 to 3.75% range. Markets have been pricing in 2 rate cuts before September 2026. The Fed's own dot plot from their last meeting projects only 1 cut for the entire year. That gap between what markets expect and what the Fed has actually signaled is the loaded spring under silver right now. Here is the mechanical chain that matters. When NFP prints strong above roughly 150,000 jobs with unemployment holding steady, the market is forced to reprice its rate cut expectations and move them closer to the Fed's more cautious 1-cut projection. When that repricing happens, real yields move higher, the dollar index strengthens, and silver faces immediate headwinds because silver is priced in dollars and highly sensitive to real yield movement. When NFP prints weak below 75,000 jobs or unemployment ticks upward, the opposite chain fires. Dovish Fed expectations get reinforced. Real yields fall, the dollar softens, and silver's dual nature as both a monetary safe haven and an industrial metal gives it 2 simultaneous tailwinds instead of 1. Now, here's what makes this particular moment structurally explosive regardless of which way Friday goes. The Silver Institute has documented that 2026 marks the 6th consecutive year of a structural supply deficit in the global silver market. 6 years in a row, the world has consumed more silver than it has produced. COMEX registered inventory has been sitting at coverage levels that represent only a fraction of outstanding open interest, creating a physical tightness in the paper-to-physical ratio that sophisticated institutional desks have been quietly flagging since the first quarter. JP Morgan's global research team published a silver price average target of $81 per ounce for 2026. Bank of America has pointed to COMEX contract dynamics as a specific volatility driver, particularly around the fact that COMEX is a duty-paid contract and the U.S. is net import dependent on silver, meaning tariff uncertainty feeds directly into physical premium spreads. The gold-silver ratio as of early June sits near 60 to 1 after compressing sharply from a cyclical peak above 100 to 1 not long ago. On June 2nd alone, that ratio tightened to 59 to 1, representing silver's 3rd consecutive outperformance session in 2 weeks. A move back toward the historical average range of 40 to 60 to 1 would be significant, but silver has already shown in January of this year what happens when a compression move catches momentum. Silver hit $121.67 per ounce on January 29th, 2026, a new all-time nominal high, before a sharp correction drove it back toward the 70s. That correction is exactly what makes the current structure so compelling to watch. The metal is not broken, it reset. It has been consolidating above $73 for weeks, and the ISM manufacturing data from earlier this week showed a prices paid index at multi-year highs, while employment subcomponents continued softening. Prices up and jobs down in manufacturing is textbook stagflation territory. The critical question is whether Friday's NFP tells us that signal has spread from the manufacturing sector into the broader 89% of the U.S. economy that manufacturing does not represent. This is where we hit the fork in the road, and I need you to stay with me because both paths here are real. Before we get to the dual scenarios, I want to stop here and ask you something directly. You are watching this because you pay attention to markets and you want to be ahead of moves, rather than reacting to them after they have already happened. But there is a difference between the person who consumes information like this, in the person who actually does something with it before the catalyst arrives. Every major silver move this cycle has been front-run by people who understood the structural setup before the trigger fired, and followed by a wave of buyers who arrived after the first 10% of the move was already gone. The data I am giving you right now is the same data that institutional desks are sitting with this week. The question is whether you are the kind of person who uses that window or the kind of person who watches the chart on Friday afternoon after the move has already happened and tells yourself you saw it coming. That is not a sales pitch, and I am not telling you what to do with your money. I am asking you to be honest with yourself about which category you have historically fallen into. Because this Friday is one of those moments where the category actually matters. Now here are your two paths forward with full chains of consequence. The bull path triggers if Friday's non-farm payrolls print comes in below 75,000 jobs added, and we see unemployment tick up even modestly toward 4.3 or 4.4%. In that scenario, the Fed cannot hike because inflation via PCE is still elevated, but it also cannot credibly hold the line against cutting because the employment mandate is visibly deteriorating. That is the stagflationary trap that makes real yields collapse and safe haven demand surge simultaneously. Silver in that environment moves toward its recent resistance near $80 to $82 in the near term, which is precisely where JP Morgan's 2026 average target sits and where the metal ran in late February before pulling back. If that move gains institutional confirmation through June's positioning data on COMEX CME, group open interest, a retest of the $90 to $95 zone before the end of Q3 becomes a live scenario rather than a forecast. The bear path triggers if non-farm payrolls print above 180,000 and average hourly earnings stay elevated above 4% year-over-year growth. In that scenario, the Fed hawks get their ammunition back and rate hike expectations re-enter the conversation for the first time since early 2026. Real yields spike, the DXY strengthens, and silver faces the same kind of sharp repricing it experienced in early February when it fell from the $83 area back toward $70 in a matter of days. In that bear path, silver's first support zone sits near $70 and the second sits near the $65 to $67 range, which represented a prior breakout level. The key difference between 2026's bear case and a structural breakdown is that the Silver Institute's deficit data does not change based on one payrolls number. 6 consecutive years of structural deficit do not reverse because of one strong jobs print. The bear path is a timing and sentiment reset, not a structural collapse, and that distinction matters for how you think about positioning around it. Here is what I cannot tell you yet. The data released Tuesday from the JOLTS report showed U.S. job openings surged in April to their highest level in nearly 2 years, while layoffs simultaneously declined. That combination, more openings and fewer layoffs, normally reads as a strong labor market signal and is part of why silver slid toward $74 this week. But JOLTS is a lagging indicator and it covers April. Friday's NFP covers May, and May is the first full month that reflects the cooling sentiment in the ISM data. Whether those two pictures of the economy agree or contradict each other on Friday morning is the question that no analyst on Wall Street can answer with certainty right now. And that unresolved tension is precisely why silver is compressing rather than trending. The compression always ends the same way. A release, the only variable is direction. Goldman Sachs has maintained that precious metals remain structurally supported through the macro uncertainty of 2026, and Bank of America has highlighted COMEX dynamics as a specific amplifier of any directional move. When the move comes, it will not be slow. Silver does not drift. It either sits still or it runs. The question is not whether this metal moves in the second half of 2026. The question is whether what is already loading in the derivatives market on COMEX right now is setting up for a move that mirrors January's run or something that makes January look like a warm-up. And the answer to that question depends entirely on a number we do not have yet. What happens when the Fed is trapped between inflation they cannot ignore and employment data that forces their hand anyway? That is the scenario I will be breaking down in full detail in the next video, because the setup that follows Friday's print may be the most important positioning window of this entire cycle.